I'm Larry Walther, and this is principlesofaccounting.com, Chapter 4. In this module, we will review the accounting cycle as well as look at the closing process. To review the accounting cycle, consider that the accounting cycle simply is a way of describing how we capture transaction event data and move it through the accounting system to the ultimate preparation of financial statements. Okay. There are various steps in the accounting cycle. Ordinarily, we think about the first step being the examination of transactions and events and the preparation of a journal entry. Those journal entries are periodically posted to appropriate ledger accounts. From those ledger accounts, a trial balance can be constructed, and examining that trial balance may provide additional reason to consider the need for adjusting entries so that income is properly measured for the particular accounting period. Those adjusting entries would be prepared, recorded in the journal, and posted to the ledger. The ledger then provides a basis for preparing an adjusted trial balance from which financial statements may be prepared. Those financial statements may be prepared directly from the adjusted trial balance, or a worksheet might be used to facilitate the process, such as was illustrated in a previous module. Moving on to the closing process. As we consider the closing process and consider why is this necessary, it's important to recall that accounting information is for periods of time. Income statements, operating statements reflect revenues and expenses for a particular period of time. And so what we have in the ledger are accounts that reflect revenues for the period, expenses for the period, and so forth. That information needs to be closed out before you begin another accounting period. In other words, the revenue accounts and expense accounts need to be reset to zero so that what will be captured in the ledger going forward is information about revenues and expenses for the next accounting period. So I say on the slide that we need to update the retained earnings account in the general ledger to equal the end of period balance. We do that by periodically closing our revenue and expense and dividend accounts. That is, we zero those out. The revenue and expense and dividend accounts are called temporary or nominal accounts, in contrast to the balance sheet accounts that are referred to as real accounts. So let's look at the closing process. You could think of this in steps. We could first think of closing the revenue account. We might, in the closing process, introduce another account called income summary. Essentially, that's a corral where we're going to gather up all of the information about all revenues and expenses. It's not a financial statement account at all. It's just an account that is used temporarily in the closing process. Similarly, we would close the expense accounts to income summary, and once that's done, the balance of income summary would reflect the amount of net income for the period that's then closed to retained earnings. Additionally, we would need to close the dividend accounts. So let's look at this in journal entry form. Here on the screen is an example of the first entry, closing revenues. Revenues have a credit balance. To close them, we'll debit revenues and credit income summary. At this point, we'll have $32,800 in the income summary account, reflective of the total revenues. The next journal entry reflects the closing of the expense accounts. Because the expense accounts have debit balances, we need to credit them to close them or zero them out, and in turn, debit income summary for the total of the expenses, $30,200. Now comparing, you see there's $32,800 that's been credited to income summary for all of the revenues, and $30,200 that's been debited to income summary for all of the expenses. That gives us a net balance of $2,600 in the income summary account. That corresponds to the net income of the business, and that is what is closed out then to retained earnings. So here I'm debiting income summary, $2,600, and crediting retained earnings in this particular entry. And notice now that would cause the income summary account to have a zero balance. That would cause the expense accounts to all have zero balances. That would cause the revenue accounts to all have zero balances. And the retained earnings account has been brought forward to its then current balance, reflecting the end of year condition. We also, though, need to consider the dividends, which are closed to retained earnings. Retained earnings over time is the undistributed earnings of the company. So here I'm crediting dividends to close that temporary account and debiting retained earnings. So to review the process then, this slide may prove helpful. Here's our revenue accounts that I'm debiting $32,800 and crediting income summary $32,800. I in turn credit all of the expense accounts and debit income summary. Then in turn I close the income summary account to retained earnings. Lastly, I'll close my dividends to retained earnings. That information then gives me a basis for preparing a post-closing trial balance. Now the only accounts that remain would be assets, liabilities, and the equity accounts, the end of period equity account balances. So a post-closing trial balance reveals the balance of accounts after the closing process. All the revenue, expense, and dividend accounts have been swept away or zeroed out. This simply demonstrates that the accounts are in balance. It is not a formal financial statement. Here's an example for England Tours Company after the closing process. Note that each of those accounts is a balance sheet account. Total debits are $65,000, total credits are $65,000. I'm fairly confident I've successfully completed the closing process. Lastly, I would like to close this module by asking you to consider computerization. First of all, computerization can do away with the need for the closing process I've just described. A number of accounting software programs are based on database logic that will maintain revenue and expense information indefinitely. And so rather than needing to close and restart revenue and expense accounts, it's sufficient to simply query the database for the period of time of interest. So one could say, give me the information about revenues and expenses for the period January 1, year 1 through December 31, year 1, or January 1, year 3 through December 31, year 3. It's not necessary that you restart the accounts at each particular period, given the robust character of a sound computer-based accounting system. Financial results for almost any period of time can be created, and the closing account becomes far less relevant.